You ever feel like you're just fighting the market? Like it's this completely random, chaotic mess? Well, what if I told you it's not? The market actually moves in just 3 distinct states. And once you learn to see them, I'm telling you, everything on that chart is going to start to click.
So, let's start with a question that I know drives traders crazy. You find a strategy, it's working like a dream, and then, boom, out of nowhere, it just completely falls apart. You start second-guessing everything. But what if the problem isn't your strategy at all? What if it's because the market's entire environment changed and your strategy didn't change with it? I mean, does this sound familiar? You're trying to use a trend-following strategy, right? You're looking for those higher highs and higher lows, but you're doing it while the market is just chopping sideways. It's kind of like trying to sail a huge ship in a tiny bathtub. It's just not going to work. Or maybe you do this one. You see the price getting super tight, coiling up, and you think, okay, here it comes, the massive breakout. You jump in and, well, nothing. It just fizzles out and reverses because the market just wasn't ready to expand yet.
And oh, here's the most painful one. You see this huge, fast candle you FOMO in, thinking you've caught the big one, only to watch it slam right back in the opposite direction, leaving you completely trapped. These aren't just random failures, you know? They're all symptoms of one core misunderstanding. And this is the critical shift in thinking. Most traders are busy asking these tactical questions, like, should I buy now? Or is this a real breakout? But here's the secret. Those are the last questions you should ask. The first, and by far the most important question, should always be, what environment is the market in right now? Because that answer changes absolutely everything. All right, so let's break down that first environment. This is the one everybody loves to trade. But here's the catch. It's actually the least common one. We're talking about the trend.
So what is a trend, really? It's not just price moving up or down. It's what happens after the market has already cleared out a bunch of old orders and stop losses, what we call liquidity. Think of it this way. A trend isn't the beginning of a move. It's the result of a whole process that came before it.
When a real trend gets going, the signs are unmistakable. You see that classic textbook pattern, higher highs, higher lows. You get these strong, committed moves that cover a lot of ground quickly. That's what traders call displacement. And every little pullback, it's shallow and gets bought up almost immediately, showing that one side is totally in control. This is the perfect playground for trend-following strategies.
And this is so important to get. Most people think the market is always trending somewhere. It's not. That's a huge misunderstanding. A trend is the reward, it's the payoff you get after all these other conditions have been met. Most of the time, the market is busy doing something else entirely.
So if the market isn't trending most of the time, what is it doing? Well, that brings us to state number 2, the range. This is where the market actually spends the vast majority of its time.
A range, or what some people call consolidation, isn't just the market being boring. It's actually a preparation phase. Think of it like a pressure cooker. Inside, people are taking positions, stops are being placed just above the highs and just below the lows, and all of this is building up potential energy, or, as we call it, liquidity. Inside a range, the price just bounces back and forth between a clear floor and a clear ceiling. And on both sides of that box, stop orders and breakout orders are just stacking up, building more and more liquidity. This is exactly why so many breakouts fail in this environment. The market's job here isn't to move, its job is to build. This state is perfect for mean reversion strategies, selling near the top and buying near the bottom. And here's the biggest trap of a ranging market. That little poke above the high that gets everybody super excited, it's usually not a real breakout. It's just a quick raid to trigger all those stop orders and trick eager buyers, right before the price snaps back inside the range. This little raid brings us perfectly to our third and most misunderstood state. This is the one that causes the most pain for traders, but it's absolutely essential for how the market works. Let's talk about manipulation. Okay, so what is manipulation? It's that sharp, aggressive move that seems to come out of absolutely nowhere. It has one specific purpose: to run all the stops and trigger the breakouts, to grab that liquidity before the real sustained move actually starts. It's the shakeout before the breakout. You can totally spot this phase by its personality. It looks like a fake breakout. It often leaves behind these long, nasty wicks on the candles. And it always happens right at the edge of a range, precisely where everyone has put their stops. Its entire purpose is to get as many people as possible leaning the wrong way.
Now, I know the word manipulation sounds really negative, like the whole game is rigged against you, but it really helps to reframe it.
The market needs fuel. It needs liquidity to make big moves happen efficiently. This phase is just the mechanism it uses to go get that fuel before a big trip. It's a feature, not a bug.
So, there we have it. Our 3 states: range, manipulation, and trend. The real magic happens when you finally realize they aren't random at all. They're part of a predictable, repeatable cycle that plays out over and over again on every single time frame.
Okay, here's the entire cycle in one simple picture. First, the market goes into a range to build fuel. That's the liquidity. Then, manipulation happens, a sharp move to one side to clear out all that fuel and trap traders. And only then, with the path clear and the wrong-footed participants shaken out, can the real trend finally begin. Build, clear, move. That's it. That's the market's business model.
And this brings us right back to where we started. The reason your awesome trend-following strategy suddenly dies is because you're trying to use it in a ranging market. The reason your mean reversion strategy gets blown to bits is because you didn't see the manipulation that was signaling a new trend was about to kick off. The secret is simply matching your strategy to the current state of the market.
And what this means is that sometimes the most profitable thing you can do is absolutely nothing. Instead of reacting to every little price flicker, you just wait. You wait for the market to show its hand, to complete its manipulation phase, and give you clear signs that a real trend is beginning. Patience really does pay.
If there's one thing you take away from all this, let it be this: stop trying to predict the future. Your job isn't to be a fortune teller. It's to be a really good observer. You just have to ask yourself one question. What is the market doing right now? Is it building liquidity in a range? Is it clearing it out with manipulation? Or is it finally trending?
Once you start asking that question, the chart stops being a chaotic mess and it starts telling you a story. So go ahead, pull up a chart. Now that you know these 3 states and you see how they all connect, can you start to see the market's hidden cycle for yourself?